Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. My colleague, Victor, he's going to be joining us in 5 minutes or so. But I'm going to start without him. So please bear with me. Now, obviously, thank you so much for joining us live. If you're watching this on YouTube, please consider joining us live next time so that you can ask us questions. We like to get lots of questions from the attendees as it will give us an opportunity to provide analysis on the markets that you are interested in, rather than us boring you with our usual insights on the major currencies and indices and so on. Anyway, let's begin. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. All right, so we have this webinar every Tuesday. We cover the major indices, FX, gold, and so on. We do touch on the fundamentals, but it's more a technically focused webinar. So let's begin then. We'll just go straight to the charts, and as ever, we'll start off with the dollar index. Now, as you can see, the dollar index daily chart here. What's happened is we have seen the dollar weaken a little bit in the last couple of days. This is in response to a few things. First, the pound has been rising significantly in recent days because of hawkish commentary from the Bank of England, and the markets are expecting, have raised their expectations about an imminent interest rate hike from the UK central bank. So the pound has risen. This has put downward pressure on the dollar index. The euro has likewise firmed up a little bit, not too much. And then you have the Canadian dollar, which has been rising alongside crude oil prices. Meanwhile, the likes of the Aussie and the Kiwi have been going up along with equity indices because of the ongoing risk-on sentiment, and given the sharp gains for base metal prices. So all of that is helping to keep the dollar index under a bit of pressure. And the only thing that has been supporting the dollar index is the Japanese yen, which has been falling. Again, due to the lack of any haven flows into the safe haven currency. But the dollar has now reached a key area of potential support. As you can see, I've highlighted it here. This area is where the previous rally started from, which led to the breakout above this double top high. So now that we've returned back to this area, we may see a bounce of some sort over here. Guys, just bear with me 1 minute. Sorry about that, guys. So we have a bullish trend line here as well, which could offer additional support, which means that perhaps we may see the dollar, strengthen again as we head towards the end of the month. And if it has any chance of making a strong comeback, its best bet would be against weaker currencies like the Swiss franc. It's already doing well against the Japanese yen, as I said. This is the Japanese yen, dollar yen. But the Swiss franc is a similar currency, isn't it? Like the Japanese yen. The Swiss National Bank is one of the most dovish central banks out there. And so far, we're not seeing that weakness for the franc against the dollar, as you can see on this daily chart here. But keep a close eye on it, because with the dollar index at support, we could potentially see a recovery around current levels. Okay, In any case, we want to see a confirmed bullish signal. So I would wait for the market to create a higher high before looking to go long or looking for bullish setups on the dollar Swiss. So the reason I've selected this level here is because yesterday the market created a inverted hammer candle, and we've seen some downside follow through. So far, it's looking like the dollar Swiss wants to head lower. Makes sense given the dollar index price action. Resistance comes in at 92.23, which was the low from the previous days, which is the previous day's low, basically. If it starts to move above 92.23-ish later on today, then that would be the first sign that the bears are getting in trouble and that we may see a reversal. But for confirmation, as I said, we want to see a higher high come in. And the most recent high is Monday's high at 92.74. So that's the level that needs to break, in my view, before we turn bullish on the dollar Swiss. The euro is another currency that might weaken against the dollar because the European Central Bank is still quite dovish, right, compared to the Federal Reserve. The euro has managed to bounce back ahead of the support level here at the 14.95 and the psychological level of 115. So it may return. It may turn lower from around current levels to head down to those areas, in the not too distant future. Potential resistance is right here in the shaded region as we speak. This area
basically come to it, right?
Exactly. Yeah. Oh, welcome, Victor. I didn't notice that you were there.
Yeah, no problem.
Yeah. So yeah, we are right at resistance here. This euro dollar is Victor's favorite currency pair. So I'll let you, Victor, take control of this. And yeah, what do you see here?
Well, what I'm seeing actually is, to me, some sort of paradigm shift. To be honest,
Okay.
I feel like the market is starting to bet that the Fed is not going to tighten enough.
Right.
Meaning that quickly enough, and they're starting to call the Fed's bluff of their tightening. And this is like my general feeling that we seem to be coming in at this point in the cycle where we have rampant inflation and complete denial on part of the Fed in this case that there is a problem with inflation, and this is going to hurt. This is going to hurt the economy because wages are not rising as fast as inflation is, and we're actually very far from that. And this is going to pressure the U.S. economy in the coming quarters. And for the first time since March 2020, I read this morning the Bank of America is having a negative sentiment towards the economy.
All right. Okay. Do you reckon that the Fed will allow inflation to rise even further in the short term then? Because there is a risk that we could see that given the sky high oil prices and other inflationary pressures coming in as well.
Yeah, well, they've pretty much have told us what they're planning to do, right?
Right.
We're going to have the tapering play out until the middle of next year.
Yeah.
But reality is that the market screams higher rates. We need higher rates.
Indeed. I mean, if you look at the US 2-year yields, they've been going up, generally speaking.
Yeah.
So the market wants tighter monetary policy, but The Fed is thinking otherwise. You're suggesting.
Yeah, yeah, yeah. The Fed's thinking in this case is different to the markets. And if you see the yields, yeah, did you can you go to? I think you have the yield spread between
Oh
the
yes.
US 10-year and
Which one are you talking about? Because I have quite a few yield charts. I think I have.
yeah.
Is it
I
the?
think the yield spread between the US and Germany,
Okay, it's not this one. Yes, I should be in
or
this.
yeah.
I think it's this one.
Oh, yeah, you have the general chart.
Yeah.
Just go
Okay.
back.
Okay.
Oh, okay. Yeah, there you go. Yeah,
All
yeah,
right.
yeah.
Sorry, I keep flicking. This is
So,
the yield spread, isn't it? This blue line between German 10-year bonds and or yields on bonds and the US 10-year. The black line is the euro dollar. Shall I get rid of that? So this is the yield spread.
yeah. So we're still in this range between 1.6 and 1.75 roughly.
Yeah.
Or 1.8 really. Like,
Minus.
yeah, sorry,
Yeah.
yeah, minus.
Because I put the German yields first.
Yeah, yeah.
So you'll have a minus number. Yeah.
Yeah, and over the coming weeks, if we see a break with within this spread to the upside, no,
Well,
a compression.
if we see a break to the upside, that would be positive for the euro, wouldn't it?
Yeah, yeah, exactly. Yeah, sooner or later this consolidation is going to get resolved in one way or the other. It's very important to pay attention to what's going on in Germany and its efforts to form a government. There is a very, like, for all euro traders, this is your $1 million question that no one's talking about. The new German government is likely to be a coalition between socialists, fiscal conservatives, and the Greens. So you have, yeah, the FDP, which is a key Freedom Democratic Party in Germany, is a key member of this coalition, and some people expect that the head of that party is going to demand the finance ministry. Which means that we're going to have probably a tight fiscal policy in Europe over the coming, for years.
All right.
So, if you have a fiscal conservative heading the German finance ministry, that's something that is very positive for the euro, I would say.
And potentially negative for the DAX, would you say?
Well,
or is this more of a global issue?
Having in mind that tax rates in Germany, where it's not really the place where you can raise corporate tax rates further from where they are already. I don't. Yeah. Of course, the value of the euro is impacting the DAX, but I wouldn't say that the correlation is linear.
Right. Okay.
Just this morning, if we look at the DAX, the euro is breaking higher. What is the DAX doing?
The DAX is, well, it's just unchanged, really. Little change on the day after yesterday's bearish move, but we've seen US futures rise on the day. I wouldn't be surprised if the DAX were to climb higher. So yeah, it hasn't really responded in a negative way that you might have expected
euro
given the
strength.
euro strength. Yes, if that's what you're trying to get at. It
Yeah.
is the DAX is forming this triangle pattern on the hourly chart, so it looks like it might break out. If it breaks above this level right here, this could lead to some gains towards and probably above yesterday's highs. So the level to watch is at 15,530 or thereabouts, 25, 30. This resistance level needs to break, and the DAX that should clear the way for the DAX to push higher and head towards the all-time highs, possibly because the recent trend has been quite positive for the DAX. It held the 200-day moving average after several attempts to break below. It failed, formed the double bottom here, then broke out above this area of resistance cleanly, and the last few days has been consolidating its gains. So now we need a renewed bullish trigger, and that could come in the form of a breakout from this hourly triangle pattern that you can see over here. So a break to the upside would be bullish in my view.
Yeah, I couldn't agree more.
Yeah.
Speaking of indices.
Sure. Yeah, I was gonna say one particular index that's catching my attention is the FTSE 100. The FTSE has been one of the most boring indices out there, and the reason I'm looking at the FTSE now is because it's done something that looked a little bit unlikely a few weeks ago, but it's done it. It's broken to a new high for the year. It came out of the consolidation zone that it had been stuck in for the last 6 months here. So if I put a box around this zone, maybe about here, this was the bulk of the consolidation zone. And if I duplicate this and put another box here, the fact that we've broken above it, and if we can hold the breakout, there's a possibility that the FTSE might rise at least the same distance as the height of this this box, this 6-month consolidation. So in other words, we may see 7,500 on the FTSE in the not too distant future or thereabouts. So that's where the FTSE might be headed in the next few weeks or so. But first thing is first, it needs to hold a breakout above this gray area, which was previously offering resistance. We have broken just about above it, and now retesting it from up above. If it holds here, then I would expect the FTSE to head towards the 161.8 extension and possibly higher over time. Another thing, that the length of this consolidation, 6 months or no less. That's a significant period of consolidation, and that consolidation has been resolved, or it looks like it has been resolved. Not quite significantly yet, but if we clear yesterday's high and head above the bearish engulfing candle that was printed yesterday, that would provide us the cleanest indication yet that the market wants to push higher. So the 6-month consolidation period is going to be significant because of time. This much time it took the FTSE to resolve the consolidation, then the breakout, therefore, if it is indeed a clean breakout, should be a significant one rather than a small breakout. So I would be inclined to look for bullish trades on the FTSE or UK stocks in general. And I think part of the reason for this is because the reflation trade is back on, isn't it? We have seen commodity prices go up. Crude oil has been rising for several days, weeks, months even. Copper has been going up. If you look at all the other sorts of commodities, they have done all right in recent times as well. But it's mainly been crude oil that's been driving the energy stocks higher. Precious metals have come back a little bit. Gold is still in consolidation, but if you look at silver, silver has broken above this bearish trend line, possibly suggesting that it wants to go higher. With bond yields struggling a little bit, as we discussed before. this is the US 10-year. This has allowed precious metals to stage a bit of a recovery, but still not out of the woods completely yet. Although silver is finding some demand because of its industrial properties, unlike gold, which is being held back because of the lack of any haven, or the lack of any significant demand for haven assets at the moment. Something that's also weighing on the Japanese yen. But if you recall from the start of the webinar, I discussed sorry, I'm just switching charts very quickly here. I discussed the Swiss franc. I want to talk about the Swiss franc a little bit more, because I reckon the franc will weaken against a number of currencies. Obviously against the dollar is strengthening right now, as are all the other major currencies. But if you look at the pound, pound has been one of the strongest currencies out there because of the fact that the Bank of England has turned hawkish. Bank of England's governor, Andrew Bailey, he said at the weekend that the UK central bank will have to act because of the rise in inflationary pressures, meaning that the central bank is going to hike interest rates, and the pound has responded accordingly. So I think the pound going forward, with the dollar index being at support right here, going forward, I would favor looking to buy the dips on the pound against weaker currencies like the Swiss franc, not against the dollar, but against the franc. Because, if you look at, first of all, let's look at the Japanese yen. Okay, so the pound has broken out significantly against the Japanese yen. But I reckon the Japanese yen and Swiss franc are a little bit similar in terms of characteristics, in that both central banks are a little bit more,
pretty much dovish.
Dovish indeed.
Dovish for life.
Exactly, dovish for life. And this is the pound Swiss. Okay, so pound Swiss has started to look constructive within its overall consolidation range. Yes, it hasn't broken above the bearish trend line, but if you look at the structure of price action closely, this is the 200-day moving average. If I zoom out a little bit and maybe look at the weekly chart first, so if you look at the weekly chart shows a bullish trend followed by a period of consolidation. This can be considered as a continuation pattern on the weekly time frame, right? So what do you have here? You have a bull flag, or a whatever you call it, basically a continuation pattern. Obviously, it needs to break above this to complete the pattern, leading to potentially more gains in the future. But the underlying long-term trend is bullish. So on the daily, what I've been looking at on the pound Swiss is I want to see if it can hold above the 200-day moving average. It tried to break below it a few times, but each time it tried to break down, the bearish attempts have been futile. And on Friday, we got a very nice bullish breakout right here above this area of resistance, and there was a short-term bearish trend line capping the gains at the previous several days. So we got a clean breakout on Friday. The market went above key resistance area between this level, 2650, and that was the lower end of the range, and the upper end of the range was at 2677. This is the area I was looking at to buy the dip in the pound Swiss, and I have bought the dip. Just to give you an idea that how I trade as well. Obviously, this is not investment advice or trading advice, just my opinion on how I trade. Don't have to follow me, shouldn't follow me, should always do your own research. But anyway, the bearish signals are continuing to fail the bears. Like yesterday, we had a inverted hammer candle. This on its own looks quite bearish, doesn't it? It points to a failed breakout from
Yeah.
above. Yeah, but look what happened today.
However, it could
Yeah.
be just a trap.
A trap indeed. So we broke below the low of that candle today. Just color this in black, just see. We broke below the low of Monday's range, but there was no downside follow through whatsoever. We broke about below it, trapped the sellers, and then we ripped higher. Very nice bullish price action. Similarly, if you look at these candles here, lots of bearish looking candles, but very little follow through on the downside. So what does the market do? It will go and take out your stops if you're fighting it. And this is what's happening with the bears today, I think. So where do we think the pound Swiss is headed next? Well, there's a double top here. There's going to be lots of stops above those double highs or double top. So that's where I think the pound Swiss is headed initially. But over time, I think it's going to go a lot higher because of the macro reasons, which is that the Bank of England is turning hawkish. The Swiss National Bank is not, right? So people are going to invest, more funds are going to flow into the UK banks than in Switzerland and away from Switzerland, for as long as the appetite for risk assets remain positive. So right now, stock markets are rising, and that should keep the upward pressure on this currency pair. But obviously, when risk assets start to fall and risk appetite turns sour, we may see a bit of a reversal in this pair. But over the longer term outlook, I'm quite bullish on the pound Swiss, and I reckon this currency cross is one that you should be concentrating on quite a bit in the coming days and weeks. Another pound cross is the euro pound, which we have been calling for a breakdown, haven't we, Victor, in this currency pair for a number of weeks. And finally, it looks like that motion has started because it took its sweet time. I mean, it's been in consolidation for how long? If you zoom out to the monthly time frame.
Yeah, since April, pretty much.
Was it April? Yeah. Since April, when it formed this hammer bullish candle, no upside follow through. That was that's what led us to believe that this was a false move up because there was no follow through. And indeed, that's what's happened now. We've broken below April low this month, and so the path of least resistance is clearly to the downside. Where do we think is heading from here, Victor?
Well, I wouldn't be surprised if we hit 2020's low and 2019. Yeah, we have marked it as 280, just below 83.
Yeah.
But I'm actually expecting it to go higher. I mean lower.
Lower than
meaning that I expect the
pound,
the pound to go higher. Higher than this, so it to continue rallying probably towards 82 at least.
Yeah, I mean,
initially,
if it breaks those levels down, there's no reason why it can't go lower than that, because for a start there will be no technical reason for it not to do so.
I feel like we've seen the worst of the levels for the pound, at least for the time being, at least for this cycle. You know, the Bank of England has this reputation of usually being the first major central bank to hike.
Yeah,
it's been like this in the previous hiking cycle, which was, oh my God, when was that? Probably 10 years
that was
ago.
a long time ago.
I'm old. I mean, what the current market moves do remind me about is the exit from the ultra accommodative policy first established after
Financial
the
crisis.
2008 financial crisis. So yeah, at that point in time, the pound used to be rallying significantly against the euro, pretty much until Brexit happened, and now that Brexit is resolved in a way, like there are some disputes lately, I know, but like it's mostly whatever happened. Like you won't get any significant developments from here around Brexit.
Indeed.
It's the UK still stands.
Yeah.
So yeah, I feel like the British pound is also going to stand up. It's been hammered for a long time.
Yeah.
But having in mind that the Bank of England is a very conservative institution,
Yeah.
I feel like time has come to shift
Indeed.
in policy, and it could lead to a protracted rally.
It looks that way, doesn't it? Now, while you were speaking there, I pulled up a chart of the IBEX, the Spanish benchmark stock index. And along with the global indices, it looks like the Spanish index is going to join the rally because it has broken out. It looks like it's broken out, any followers we have here who trade European stocks or indices, maybe this is another market you want to keep an eye on or trade, because it looks like the market has broken out. There's it did take its sweet time between August and where we in the final weeks of October, last 2 weeks of October, and finally it looks like it wants to break out. The longer term trend is bullish, as indicated, for example, by the rising 200-day moving average. The breakout, if sustained, can lead to a possible move to a new high for the year above this high that was hit in June. So that's the main target, if you like, for this market. But we could potentially hit a lot higher from there, depending on sentiment at the time. If I pull a weekly chart here, there's a bearish trend line, long-term bearish trend line that comes in just above this year's earlier highs, around 99,500 or so. That could be the ultimate target for this market. But just want to highlight that breakout for you guys in case interested.
So what do you think is going to happen to precious metals in this environment? We like stocks are going higher, precious metals should go lower, no?
You would think that although precious metals have traded a little bit independently of one another in the last few days, gold has been stuck between a hard place and a rock, so to speak, because equity markets rallying, it's reducing the appeal of haven assets like gold. But if you look at silver, it has had a more of a significant rally than gold, at least in percentage terms. But gold, last time we looked at gold, it was rising to test 1800. We thought it might turn around from there because of the convergence of the 200-day moving average with resistance, with a bearish trend line. Lo and behold, it did. And it did. It's attempting another breakout attempt today after forming a indecisive.
You see, I love my head and shoulders patterns. And can we switch over to the 4-hour chart?
Sure.
So we had a break, a show above 1800, and I feel like we might be seeing another head and shoulders pattern being formed right now, around 1780 being the top of it.
Yeah.
And for a potential return back to test the base at 1760, and then further on towards 1745 or thereabout. But yeah, let's see how this goes.
It's
I'm
a
just saying
potential
that
potential shoulder. It's not formed yet, but
yeah,
given how gold has been behaving of late, I wouldn't be surprised if it forms a lower high here and head
yeah,
back down
if
as Victor
the
envisages.
equity market keeps
Yeah.
rallying, basically the possibility for a gold move lower is pretty
Yeah.
high.
One point though, gold and equity markets have been correlating more positively in the last 3 or 4 years, I've noticed. And it's all to do obviously with major central banks unleashing record amounts of QE and printing money and whatnot. And that, some of that money has found its ways into cryptos, into precious metals, and all sorts of assets, houses,
Yeah,
properties. So in that regard, the negative relationship between gold and equity markets have weakened a little bit. Nonetheless,
yeah,
right now, because of the rallying equity markets, investors are still preferring the racier stocks over haven assets. So I would concentrate on equities until the chart of gold show us a clear breakout. In the meantime, trading the ranges, I think, is the way to go for gold. So yeah, I don't like Victor. I don't have too strong a view on gold, especially when yields are still elevated and rising. Not just in the US, but if you look at the German 10-year, we have peaked above the 2020 highs, albeit still below the zero level, but rising nonetheless. In the UK, the 10-year has risen to almost it reached 1.2 before pulling back, and now it's tested support right here, and it's bounced. So yields are rising across the board, which is usually not a positive sign for gold, because they increase the opportunity cost of holding gold. If you're a yield-seeking investor, you can get a fixed return of 1.2% investing in UK bonds. But if you're investing in gold, you won't get that, and it might cost you money to
you would
store gold.
be merely relying on future appreciation.
Capital appreciation. Yeah. So
Yeah.
so there's a guaranteed income that you can get from fixed income, but you won't get that from gold, which makes gold more of a riskier asset, obviously. But at current, in the current climate, it's very difficult to be positive on gold, I have to say. Even though I love gold. I think long term it will go up. I just don't think that right now is the right macro backdrop for it to do so. It could change within the next few weeks or months, but let's see. And a lot will depend on the direction of the US dollar. So for that reason, keep a very close eye on what the dollar does here.
And
key support.
Have in mind, if you start looking, seeing, for example, that the dollar is declining, but gold is also going lower, that should serve as a warning sign that investors are really losing appetite for gold. If both of these things are happening at the same time, this is a very bearish signal for gold. Historically, you can check it out and browse through the charts back in time and look when for those times when the dollar has been rallying and the dollar has been declining and gold has also been declining. You'll find a few times in history when that happened, and it resulted in pretty sharp corrections in gold.
Indeed. Finally, let's have a look at a few cryptocurrencies, and then we will end the webinar because we've waited for your questions, but they haven't arrived. So, looking at Bitcoin, first of all, the trend continues to remain positive. It looks like Bitcoin has formed a base above 60,000 now. The last few days, it has held there.
Yeah.
So I would be very surprised at this stage if Bitcoin does not break to a new record high, because we are very close to it.
Yeah.
Yeah. So let's see what could happen if and when it breaks to a new record high. If it breaks out and holds the breakout, that would keep the bullish bias intact. If we see a false move, a false breakout, then that could complicate the picture a little bit. Even then, we'll need some confirmation before turning bearish completely on Bitcoin. But yeah, the underlying trend is clearly bullish for Bitcoin. Same with some of the other cryptos. Ethereum is. I haven't updated this chart for a while, so it looks a little bit untidy. The market has been going up. The trend is bullish. Resistance levels such as this, continue to break. We had some resistance here, broke above, came back down, retested, held a support, and we have bounced. So the next level up above would be around here somewhere, around 4,000. Dollars. I reckon with sentiment towards cryptos being positive at the moment, we might see a move up and away from that level as well in the days ahead. That's at least what I'm expecting. Let's see if it happens that way. Not all cryptos are rallying, as you can see. For example,
not all cryptos are created equal.
Yeah, exactly. Cardano here.
Yeah, keeps on trailing.
Yeah.
I mean, altcoins keep on trailing on Bitcoin's lead.
Yeah.
For some reason. Curious what that is. Perhaps.
Well, actually, there is some event happening today. I'll tell you exactly what it is. I think I read somewhere that it is a Bitcoin ETF is going to be launched today.
Right.
And do you know the ticker symbol for it?
Well, it's not really a Bitcoin ETF. It's a Bitcoin futures ETF, right?
Bitcoin futures ETF. But the ticker symbol for it, apparently, I don't know if it's true, but I can't confirm. But the ticker symbol is going to be BTFD. Buy the freaking debt.
Okay.
That's the ticker symbol for the Bitcoin futures ETF that's going to be launched today, apparently. So it looks like there's some investor enthusiasm to remain long Bitcoin ahead of the release of that ETF. Obviously, Bitcoin has been become more acceptable as a method of payment in a growing number of countries. Obviously, not China, but it looks like the market has shrugged off China completely, and is happy to continue pushing higher. Anyway, enough of Bitcoin and cryptos, and enough of talking. So I hope you guys join us again at the same time on Tuesday of next week. And for those of you who watched the recording of this, please make sure you join us then. And you can do that by going to our website, thinkmarkets.com. Go to market analysis, live webinars, and then you can register for one of our upcoming webinars by clicking on the register button. Okay?
Yeah.
I hope to see you guys then. Take care. Bye-bye.
Take care. Bye-bye.